Welcome to the deep dive. Today, we're taking that shortcut to knowledge, plunging right into the very complex world of quantum computing. We're looking specifically at Rigetti Computing, Inc., ticker RGTI.
Yeah, and this is a custom deep dive for you, our Stock Analytics AI members.
Absolutely. And Rigetti, it's such a fascinating, maybe paradoxical company to tackle.
It really is. I mean, we're studying a stock that presents this almost unbelievable financial picture. Rigetti's whole claim is building the world's most powerful computers, right? Promising this revolutionary multi-trillion-dollar future.
But the present reality, it just seems so starkly different. You look at the market cap, what is it, around $14.35 billion?
Massive. Puts it up there with established tech firms.
Exactly. And then you look at the revenue, the trailing 12 months. It's barely $8 million, $7.93 million to be precise.
It's a staggering disconnect. And that's really the core mission today, isn't it? To figure out if Rigetti is genuinely laying the groundwork for a world-changing industry, or if this valuation has, just quantum leaped way too far ahead of itself.
And the answer, well, as you're about to hear, it seems to lie less in the current earnings and more in the extreme expectations the market's already baked in.
Precisely. Our analysis points to this significant, almost structural disconnect between Rigetti's current fundamental reality and where the stock is trading. We've dug through the filings, the tech roadmap, the sentiment.
And the core finding?
The core finding is this. Even the most bullish analysts on Wall Street, the ones running these really aggressive future growth models, they just can't fundamentally justify the current share price. Was it $44.27?
Around there, yeah.
So we're basically going to walk you through why Rigetti's stock seems fundamentally ahead of itself right now.
Okay, and just a quick note for you listening, if you want full access to everything we do, it's $4.99 a month. That gets you our playlist of 500 deep dives covering the entire S&P 500.
And coming up next, exclusively for members, we're tackling the NASDAQ 100. Plus, you can request tickers, just drop them in the comments.
All right, let's dive in. Part 1. Digging into the company's foundations. Okay, let's start with Rigetti's basic operational blueprint.
Chapter 1. Business Understanding.
So Rigetti's big bet, their core strategy in this whole quantum race is this full-stack integration idea. They're not just doing software or just hardware. They're aiming for the whole package.
Yeah, and that full-stack approach, it's really their defining trait, but it's also, frankly, their biggest gamble. They're taking on everything, designing and actually manufacturing their own superconducting quantum processors.
Right, managing the whole supply chain.
And then delivering access through their cloud platform. Now, this gives them theoretically superior control. They can tweak the hardware and software layers together for better optimization.
But the cost, the capital demands must be enormous.
Immense. Absolutely immense. Which brings us to their key in-house assets. We have to talk about Fab 1.
Fab 1, explain that.
Fab 1 is absolutely critical. It's their own dedicated, integrated quantum device manufacturing foundry. Think of it like a hyper-specialized factory just for making these incredibly fragile, exotic quantum chips.
So not like a standard Intel fab.
Not at all.
Yeah.
And having it in-house, instead of relying on external semiconductor foundries, means they can iterate on their chip designs much, much faster. It speeds up the whole R&D cycle.
Which they need, presumably, because they're trying to crack one of the biggest nuts in quantum scalability, getting more qubits reliably.
Exactly. And that's where their proprietary multi-chip tech comes in, especially with the Ankaa series chips.
Okay.
See, the superconducting qubits, they're notoriously tricky to scale up on one single chip, a monolithic wafer, without introducing just fatal levels of errors.
Right.
So Rigetti's approach is basically to tile smaller, hopefully more reliable chips together to create a larger, more powerful system. It's kind of an engineering workaround to get to higher qubit counts.
A modular approach.
Pretty much. It offers a potential path to scale that maybe some rivals with different tech don't have as easily. But, like we said, the vulnerability is Fab 1. If they hit a major snag in their manufacturing yields,
The whole pipeline grinds to a halt.
instantly compromised. R&D, commercial delivery, everything. It's a single point of failure in a way.
Okay, so this high-risk, high-reward integrated strategy,
Yeah.
how does it actually make money? We mentioned that $7.93 million revenue figure. Where's it coming from?
Well, it breaks down into two main buckets. The first, and probably the long-term focus, is QCaaS, Quantum Computing as a Service.
QCaaS.
This is about democratizing access. They offer cloud-based ways for universities, companies, even startups, to run quantum experiments on Rigetti hardware without needing to build their own billion-dollar cryogenic setup.
And the partnerships are key there, right? Getting onto platforms like Amazon Bracket on AWS or Microsoft Azure Quantum.
Huge. Absolutely huge. It leverages those existing cloud ecosystems, lowers the barrier to entry for potential customers dramatically, makes it much easier to just try it out.
Okay, so that's stream one. What's the second?
The second stream, which can be a bit more volatile, is technology development contracts. These are usually bespoke, highly specialized projects.
Often with government agencies.
Exactly. NASA, DARPA, the Air Force Research Lab, those are key examples. These contracts do a couple of things. They bring in foundational cash, often non-dilutive, which is great.
And validation. Third-party proof the tech works for serious tasks.
Crucial validation, yes. But there's a tension there.
How so?
Well, you're dedicating your very finite pool of highly specialized quantum engineers to some specific, maybe one-off government project.
When they could be working on the scalable, commercial QCaaS product that you hope will be your main business eventually.
That's the resource allocation challenge they constantly face. And, we might be seeing hints of that tension in their recent revenue trends, which we definitely need to dig into later.
Okay, let's zoom out a bit. The overall market. Quantum computing, everyone says it's exploding. Projections are talking CAGR over 30% for decades, maybe a $20 billion market by 2030.
The potential is just immense, yes. But the competitive landscape is, let's say, fierce and complex. It seems split in two.
Okay.
First, you've got the tech behemoths with incredibly deep pockets. Google, IBM, Microsoft. For them, quantum is sort of an extension of their existing cloud dominance, backed by almost limitless R&D budgets.
And the second group.
That's the pure play specialists, like Rigetti. But also companies like IonQ, who use a different technology called trapped ion and D-Wave, which focuses more on something called quantum annealing. It's not one single race, it's multiple races using different technologies.
And that technological divergence, that's a massive risk factor, isn't it? Rigetti is betting big on superconducting qubits.
They are, which means they rely on that extreme cryogenic cooling down near absolute zero to keep the qubits in their delicate quantum state. They're potentially very fast calculators.
Oh, fragile.
Incredibly fragile and sensitive, whereas IonQ, for example, they're backing trapped ion technology.
Okay, for someone who isn't a quantum physicist, what's the basic trade-off there? Why does Rigetti's choice matter so much?
It's kind of a classic engineering trade-off. Think speed versus stability. Imagine you're trying to have a really complex, accurate conversation. Trapped ion systems are maybe like having that chat in a super quiet, isolated library.
Okay, stable, high fidelity.
Right. But potentially slower to compute, and historically, maybe harder to link lots of them together for massive scale.
And Rigetti's superconducting system is?
That's more like trying to have that same conversation in a noisy sports arena. Superconducting qubits can operate faster, potentially offering quicker calculations.
But the noise.
Exactly. They're hypersensitive to environmental noise, vibrations, magnetic fields, everything. And they need that extreme, expensive cooling. Just maintaining coherence, keeping the quantum state stable long enough to finish a calculation gets exponentially harder as you add more and more qubits.
So if IonQ or someone else with a different tech figures out scaling or error correction first.
Rigetti's whole path could be marginalized almost overnight. It's a huge bet on a specific technological horse.
Wow, okay. The barriers to entry seem insane. Technical complexity, the sheer capital needed for Fab 1 and all that cooling.
And the talent. There's a profound global shortage of people who actually understand this stuff.
Yet Rigetti points to a couple of advantages. First, their IP portfolio, 252 patents total, 112 issued, 140 pending. That's a decent moat.
It is. And second, they claim a cost advantage. They say their control systems cost about $10,000 per qubit, which they compare to rivals supposedly spending $35,000 per qubit.
If that holds true at scale.
It's a potentially huge competitive lever in a market absolutely defined by massive capital expenditure. Big if, though.
Okay, let's pivot from the tech to the people making the decisions.
Chapter 2, Management Evaluation.
And the big story here seems to be that leadership transition back in December 2022. They swapped out the founder, Dr. Chad Rigetti, a physicist,
Right, the science guy.
for Dr. Subodh Kulkarni as the new CEO and president. What does that signal?
It signals a major strategic pivot. It basically says Rigetti recognized they needed to move beyond the pure, can we make this work in a lab phase, and into the much harder, grittier reality of manufacturing, scaling, and actually selling this stuff commercially.
So Kulkarni's background fits that.
Perfectly. He's an operations executive through and through. Over 30 years in the semiconductor industry. He had a very successful run leading cyber optics, grew it massively, eventually got it acquired. You're essentially trading the scientific visionary for a proven scaling expert.
It sounds like shifting gears from can we build one to can we build a million reliably and make money doing it?
That's exactly the transition. And it's often where brilliant science either finds a path to profit or just fizzles out.
Yeah.
Kulkarni's job is pretty clear.
Yeah.
Stop the revenue slide, slash the cash burn, and turn this amazing tech into something resembling a sustainable business.
Okay, but here's where we hit that really jarring contradiction, the insider situation.
Ah, yes. This is crucial.
So the CEO, Kulkarni, he's out there projecting confidence, right? Saying things like, Rigetti has plenty of cash to get quantum computers commercial and get ourselves to a profitable stage. Public confidence.
But then you look at the public filings, the SEC forms,
Yeah.
and the actions of the board members, the insiders who have the deepest non-public view of the company's real challenges, while they tell a completely different story.
What are we seeing?
In just the last 90 days, these corporate insiders have sold over $10 million worth of RGTI stock.
10 million out. And how much buying?
Zero. Precisely zero corresponding purchases by insiders in that same period.
Wow. Okay, 10 million net selling. And it's not just one person catching out a few options, is it? You mentioned several directors.
Multiple directors making substantial sales. Helene Gail Sanford, Thomas Iannotti, Ray Johnson, Michael Clifton. Look, the standard explanation is always, oh, it's just tax planning or portfolio diversification.
Right, especially when the stock has run up on, say, those geopolitical rumors or the NVIDIA partnership news.
Sure. But the sheer volume here, over $10 million, and the completely one-sided nature of it all, selling, no buying, that really argues against the simple diversification story.
It suggests something more.
It strongly suggests a lack of conviction among the people who know the company best, that it can actually sustain its current very high valuation. You know, if you truly believe the stock was heading way higher, would you be selling millions right now? It feels less like taking prudent profits and more like hedging against the current price being too high.
It's a huge red flag, the ultimate skeptical data point, maybe.
Okay, shifting to capital allocation, it looks like a classic pre-revenue high-growth playbook.
Absolutely. No dividends, no share buybacks. That's unthinkable at this stage.
All the capital goes back into the business.
Every single dollar poured straight back into R&D to push the science forward and into CapEx, mainly for upgrading that critical Fab 1 facility. Their focus is entirely on deploying capital to achieve breakthroughs, not generating a return on capital yet.
Which explains the deeply negative return on equity, what was it, minus 29%? Minus 29.05%. It's just the reality for a company like this. But it reinforces the idea that investing here isn't about current financial performance at all. It's purely a bet on future technological success. A big bet.
All right, let's face the numbers head on. We need to move past the technological excitement and see if the finances can actually support the marathon they need to run.
Chapter 3. Financial analysis.
We keep coming back to this core paradox, that $14.35 billion market cap.
Versus just $7.93 million in trailing 12-month revenue.
The scale of that gap is just mind-boggling. How do you even begin to explain it?
It's really a textbook case of what you might call a long-duration asset valuation. The market isn't pricing Rigetti based on what it earned in 2025, or even what it might earn in 2026.
It's pricing in the dream.
It's pricing in the dream of what Rigetti could be if, and it's a huge if, it achieves market dominance in, say, 2035 or 2040. It's basically applying a venture capital-style bet on future disruption directly onto the public stock market.
Okay, but even within that bet on the future framework, the actual revenue trend is worrying, isn't it? It's not growing exponentially, it's actually shrinking.
That's the really concerning part against the hypergrowth narrative, yes. Revenue peaked at $13.1 million back in 2022. Then it dropped to $12 million in 2023, $10.8 million in 2024, and now $7.93 million TTM for mid-2025.
Why would revenue be declining in a market that's supposedly exploding?
Well, one strong possibility ties back to that strategic pivot we discussed. Remember the shift away from those bespoke development contracts towards the scalable QCaaS model?
Under the new CEO, Kulkarni.
Right. The old CEO, the physicist, might have prioritized winning those validation contracts even if they weren't very scalable. Kulkarni, the operations guy, is likely focusing resources laser sharp on standardized commercial products.
Meaning they might be intentionally letting some of those older, non-scalable development contracts wind down or expire.
That seems plausible. It would cause short-term revenue pain, a decline like we're seeing, but it could be a necessary step if they truly want a viable, scalable commercial future based on QCaaS. Shedding the low-margin, time-intensive stuff to focus on the bigger prize.
Okay, a risky but maybe logical move from Kulkarni's perspective. Still painful to see declining revenue, though.
It is. And meanwhile, the losses are just continuing. They actually had a decent gross margin in 2024, 53%, which gave them $5.7 million in gross profit.
But the operating costs.
Swamped it. Operating loss was a huge $68.51 million, and the net loss blew out to over $200 million, $200.99 million, thanks to all the ongoing R&D and infrastructure spending.
Which leads us to the cash burn. How much are they burning through?
The free cash flow is consistently deeply negative. The burn rate seems to be hovering around $60 million a year.
$60 million annually just to keep the lights on and the scientists working.
Pretty much. That's the nut they need to cover. Now, on the plus side, their near-term balance sheet actually looks okay. They're effectively debt-free now, which is good.
Reduces risk.
And their liquidity looks strong. A current ratio of 7.09 as of mid-2025 is exceptionally high.
But that liquidity, that cash cushion, it came from somewhere, right? Equity offerings?
Mostly, yes.
Yeah.
Recent equity offerings have bought them time. They have a multi-year cash runway based on current cash levels and that burn rate. But that's the crucial caveat. It's a finite resource.
The clock is ticking.
The clock is absolutely ticking. That $60 million annual burn is eating away at that cash pile. They have to achieve significant technological milestones like error correction and find a path to commercial viability and revenue scale before that cash runs out, or they'll be forced back to the market for more funding, likely diluting existing shareholders further.
Okay. Now, the valuation metrics themselves, PE is negative, so useless. But the price to sales, the PS ratio.
This is where it gets truly extreme. Rigetti's price to sales ratio is standing at an astronomical 1,330 times.
1,330 times trailing revenue. It's hard to even comprehend.
It really is. I mean, this isn't just buying future potential. It's like buying the estimated profits for the entire next century today.
How does that compare to peers? Other speculative quantum companies?
It blows them away. IonQ, which is also highly speculative, trades around 273 times sales. D-Wave is around 402 times sales. Rigetti is priced at more than 3 times the premium of its already highly speculative peers.
So the market isn't just betting on Rigetti succeeding, it's betting on utter dominance, near monopoly status.
That seems to be the level of belief baked into that 1,330x multiple. Success isn't enough. It has to be overwhelming, world-beating success.
Which makes standard valuation tools, like a DCF, almost impossible to use meaningfully, right?
They become purely academic exercises in playing with assumptions. You can run a discounted cash flow model, sure, but the inputs you need to plug in to get anywhere near the current $44.27 share price are, well, they border on science fiction.
What kind of assumptions are we talking about?
You need incredibly aggressive long-term growth rates. Think 35%, 45% annual revenue growth sustained for a full decade or more. And, crucially, you have to decide on a discount rate.
And given the risks here, that discount rate needs to be high.
Very high. We use 20% in our illustration. Normally, for mature companies, you might use 8–10%. Why 20% for Rigetti?
The risk of complete failure.
Exactly. It reflects the risk of catastrophic failure. In quantum, failure isn't just missing earnings, it's a rival technology leaping ahead, making your entire multi-billion-dollar investment in superconducting qubits potentially worthless. That 20% discount rate tried to capture that immense technological and execution risk.
And even with high growth, that high discount rate kills the present value.
It dramatically reduces the present value of those far-off future cash flows. So even with those optimistic growth assumptions, applying a realistic risk-adjusted discount rate like 20% almost certainly spits out an intrinsic value far, far below the current $44.27 market price.
So to justify $44.27 today, you basically need to assume near-perfect execution, decade after decade, market dominance, robust profit margins appearing out of nowhere, and you have to minimize the discount rate you apply, essentially ignoring the massive inherent risks.
It's a bet on perfection, plus some luck, projected decades out, discounted back very gently. It's a fragile valuation thesis.
Okay, let's broaden the view in part 2. Look at the external forces, the market context, starting with Chapter 4, Market Sentiment.
And here we hit another paradox, really, the analyst paradox. If you look at the consensus rating from Wall Street analysts covering RGTI, it's generally strong buy or moderate buy.
So they like the story, bullish on the theme.
Clearly bullish on the long-term idea of quantum computing being transformative. Yes, they buy into the narrative.
Yep.
But then you look at their actual price targets, the numbers their models spit out. The consensus 12-month price target is only somewhere between $26 and $28.
Wait, the consensus target is $26, $28, but the stock is trading at $44.27.
Exactly. Even the optimistic end of the analyst range barely hits $50. The implication is crystal clear. The analysts' own fundamental models suggest the stock should drop more than 36% from where it is right now.
So they're saying buy, but their math says, hold on, it's way overpriced.
That's the disconnect. It strongly suggests the stock is currently trading not on fundamentals, but on momentum, narrative, and maybe most importantly, external catalysts.
Like what's been driving it lately?
Two things stand out recently. First, back in October 2025, there were those geopolitical rumors flying around.
The talk about the Trump administration potentially taking equity stakes in U.S. quantum firms to compete with China.
Right. That's a massive potential tailwind. For a company like Rigetti, burning cash and needing validation, the idea of government investment is huge.
Why is government equity so different?
Well, it could mean non-dilutive capital, first off. It bypasses normal market scrutiny. And it essentially stamps the technology as a critical national security asset, which can override purely financial concerns. The stock popped on those rumors and stayed elevated even after they were officially denied.
Okay, geopolitics. What was the second catalyst?
Technological validation. They announced support for NVIDIA's NVQ-Link platform.
Partnering with NVIDIA is always a big deal.
It's a powerful signal. Having NVIDIA, a giant in high-performance computing, integrate Rigetti suggests their approach is seen as viable, at least potentially, for enterprise-level quantum workloads down the line. It adds credibility.
And technically, the chart reflects this momentum.
Oh yeah, strong uptrend. The stock's trading well above its key moving averages. The 50-day and 200-day are both clustered around $40.50, acting as support. There is significant short interest, about 13% of the float.
Meaning lots of people are betting against it.
Yes, but the days to cover ratio is very low, only 0.6 days, which means it would take less than a day for all the shorts to buy back their shares based on average volume.
So probably not much risk of a short squeeze artificially pumping the price higher.
Seems unlikely based on that low days to cover number. The momentum looks more driven by those catalyst events and the overall theme.
Okay, let's look at who actually owns the stock. Chapter 5, ownership structure. And here we come back to that contrast between the big institutions and the insiders.
Right. Institutional ownership is pretty high, somewhere between 35% and 47%, depending on the source. The biggest holders are the usual suspects, Vanguard Group and BlackRock.
Holding around 7% each.
Roughly, yes.
Yeah.
And interestingly, both significantly increased their positions recently. Vanguard up 61%, BlackRock up 40%.
But we need to be careful interpreting that, right? Especially with Vanguard and BlackRock, a lot of that buying could just be passive index tracking.
That's a very important point. As RGTI's market cap grew, or as it entered certain indices, these huge passive funds would be almost obligated to buy shares, regardless of whether their managers have strong conviction in the company itself. It provides stability, sure, but it's not necessarily active endorsement.
And that contrasts sharply with the active conviction or lack thereof from the insiders.
Exactly. As we discussed, insider ownership is incredibly low, just 1.9%. And the story there isn't buying, it's that consistent, heavy, one-sided selling over $10.3 million net outflow in just the last 3 months.
So when a director like Helene Gale Sanford sells almost $2.8 million worth on one day,
or when you see multiple top executives consistently reducing their stakes while the price is high, it really forces you as an outside investor to weigh things up.
yeah.
Do you trust the passive index buying or the active informed selling by the people who know the company's internal workings best?
It's a stark choice, a profound conflict in the signals. Okay, let's try to pull all these threads together now. Internal factors, external forces. Chapter 6, risk assessment using a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Sounds good. Let's start with the strengths, the internal competencies Rigetti brings to the table.
Okay, what have they got going for them?
Well, that proprietary multi-chip technology we talked about. It offers a potential pathway to scaling qubits that might be unique. They definitely have strong intellectual property. Those 252 patents create a barrier.
And the full stack integration, including owning Fab 1, control.
Critical control over the whole process, yes.
Yeah.
And you have to add the external validation they've achieved through high-profile partnerships, NASA, DARPA, even commercial players like HSBC looking at financial applications. It shows the tech isn't just theoretical.
Okay, those are the strengths. What about the weaknesses, the internal limitations?
This is where the picture gets pretty challenging, primarily financial and managerial. That declining revenue trend we highlighted is a major weakness right now.
Coupled with the huge losses. $200 million net loss in 2024.
Astronomical losses, yes. And the persistent negative cash flow, that $60 million annual burn rate, Means they're constantly destroying capital just to stay operational.
The technology itself is still pre-commercial, really. Heavy R&D focus.
Absolutely. Still very much in the development phase. And then you have that undeniable weakness, signaled by the lack of management and director conviction. The massive insider selling just casts a shadow over everything at this price level.
All right. Strengths, weaknesses. Now, opportunities, the external potential. This is why the stock is priced where it is, right?
This is the entire bull case, pretty much. First, the sheer size of the potential market. That 30% plus CAGR projected for quantum computing overall is enormous, if they capture even a decent slice of that.
Massive upside. And the geopolitical tailwinds.
Hugely important. Governments, particularly the U.S., treating quantum supremacy as a strategic necessity in the competition with China means potential funding, contracts, and strategic investment that could bypass normal market logic.
And then there are the applications themselves. What could quantum actually do?
That's the transformative part. Revolutionizing drug discovery and pharmaceuticals, optimizing complex financial models, supercharging AI development, breaking encryption for defense. The potential impact is genuinely measured in trillions of dollars if they can crack it.
Okay, massive opportunities, but balanced against equally massive threats. The external challenges.
Definitely. First and foremost, intense competition. Not just from other pure plays like IonQ, but from those deep-pocketed tech giants, Google, IBM, Microsoft, who can afford to burn cash on quantum R&D almost indefinitely.
But maybe the biggest threat is the technology itself.
Technological obsolescence, absolutely. This is the existential risk. If a rival qubit technology, maybe trapdyne, maybe photonic qubits, maybe something else, entirely proves superior, more scalable, or achieves error correction first, Rigetti's entire bet on superconducting technology could become irrelevant almost overnight.
Making flawless execution absolutely critical.
Near flawless execution is demanded by the current valuation. Any significant slip-up on their ambitious, decades-long roadmap could be fatal to the stock price.
And broader economic factors.
Macroeconomic headwinds are a real threat, too. High interest rates, like we've seen, disproportionately hurt these long-duration growth stocks.
Yeah.
Why? Because higher rates mean you discount those far-off future profits much more heavily, crushing their present value.
Makes sense. Anything else? Supply chain.
Yeah, supply chain risks are always there for complex manufacturing. Think about tariffs, like the hypothetical U.S.-imposed tariffs of 2025 mentioned in the outline. Stuff like that could disrupt the flow of highly specialized cryogenic equipment or semiconductor components needed for Fab 1, driving up costs and potentially slowing down their development timeline. Lots of external threats.
Okay, that brings us to the end game. Chapter 7, conclusion. We need to synthesize all this. The bull case versus the bear case. Where does it net out?
Okay, the bull case in a nutshell. Rigetti is a pioneer. They have a unique integrated full-stack model backed by their own Fab 1 and strong multi-chip IP. They've got a decent cash runway giving them time to execute. And they're playing in an absolutely explosive market with strong government interest. It's a bet on the tech and the team.
And the bear case.
Fundamentally financial and managerial. Declining revenue right now. An extreme, almost nonsensical price-to-sales multiple of 1,330x. Consistent, huge losses and high cash burn. Immense technological uncertainty is superconducting even the right horse to back. And critically, that pattern of insider selling screaming a lack of conviction at this price.
So, summarizing the valuation again, the current $44.27 price is just completely detached from today's reality.
Entirely untethered from any verifiable current fundamentals. It is purely a massive, long-dated bet that Rigetti will not just survive the incredibly difficult quantum race, but emerge as a dominant market leader maybe a decade or more from now.
And justifying that price requires...
But again, believing in near-flawless operational execution, year after year, and accepting wildly aggressive assumptions about profitability emerging far, far into the future, while simultaneously downplaying the enormous risks involved.
So the final outlook for you, the listener, trying to make sense of this.
Look, investing in RGTI at this price level isn't traditional investing as most people understand it. It's highly speculative. It's much closer to a venture capital style bet on a potential technological miracle.
High risk, high reward.
Extremely high potential reward. If they pull it off, yes, it could be transformative. But the risk of permanent capital loss is equally substantial if their execution falters, if market sentiment shifts, or, critically, if their superconducting technology path just gets leapfrogged by a competitor.
So maybe the final provocative thought for the listener, given that geopolitical angle.
Yeah, the ultimate question might not be if quantum technology itself will eventually succeed. The momentum there seems unstoppable. The real question for Rigetti at $44 is, are those government tailwinds, that strategic imperative, strong enough to effectively override the fundamental laws of financial gravity that the current valuation seems to be ignoring?
And tied to that, is Rigetti's specific superconducting path the one that ultimately survives this brutal technological race? Or are they betting on the wrong horse? That's what you need to decide.
Hmm. Okay, that wraps up our deep dive into the complex world of Rigetti Computing. Thanks so much for joining us. And remember, for just €4.99 a month, you get full access to our library, 500 deep dives on all S&P 500 stocks already there.
And next up, exclusively for members, we're tackling the NASDAQ 100. Plus, you can always request a specific stock deep dive. Just drop the ticker in the comment section and we'll get on it for you.
So please, like and subscribe to Stock Analytics AI. And just a necessary reminder, this analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be considered financial advice. We strongly encourage all listeners to do their own thorough research or consult with a qualified financial advisor before making any investment decisions.